Welcome to Handcrafting Your Retirement with Brett Ramsey from Artisan Wealth Strategies. In this podcast, we help retirees as well as those who are considering retirement overcome generic wealth management advice that limits your future. We do this by handcrafting customized financial strategies centered on your unique lifestyle. Jump on board for this journey where we delve into strategies that can help make your money outlast you, as Brett draws from years of experience with guest experts to eliminate cookie-cutter saving strategies.
Well, this is a good story today because it's actually two stories, and normally my stories are about the topic that we're on, but today it's more about my guest. So my guest today is my father, Charles Ramsey, and so this particular set of stories, I think, encapsulates why what I try to tell so many of my clients is you didn't get to grow up with my dad, and I did. And so I spend a lot of my time in my life trying to help share with my clients lots of the things and lessons that I learned from my father. So I think there were two stories in particular that happened when I was in middle school that really, I think, encapsulate a lot of that relationship. So the first one is we moved quite a bit growing up. Dad worked for a large company, and about from the age of, I think from 4 until 14, we moved about every 18 months to 2 years to a new town. And when I was in middle school, it was starting to matter. I was an only child. And so, I'd start to make friends and then we'd move. And so one of the things that I did to pass my time is I played a lot of basketball. And then when we lived in Ohio, my dad had gotten me a basketball goal, and we put it in the driveway. And I was literally out there every single day shooting baskets. It's what I love to do. And I'd wear a basketball out and I'd wear the net off the basketball goal. And I'd play my dad, my mom, anybody that'd show up, I'd play them. And I love playing basketball. And we got to the new house, and I said, "Hey, Dad, when are we going to get a basketball goal?" And he said, "Not my responsibility to get you a basketball goal." He goes, "You need to save up your money and be able to buy your own basketball goal." And so he took me to the store and he let me shop for basketball goals, and we came up with one, and we found out the price, and I can still remember. So this was in the 1980s, but to buy a Huffy basketball goal, which was the cheapest one that you could buy at Kmart, it cost $100. And I said, "Well, great." I said, "How am I going to get $100?" And he goes, "You need to start to find a job. You need to figure out how to make some money." So I started doing odd jobs and mowed yards and did everything I could. And when I came up with $100, I said, "I got my $100." And we went down to the store and we bought that basketball goal. And as we're getting that basketball goal, he looked at me, goes, "How are you going to put it in the ground?" And what he taught me there was two things. One is that there's not just the goal, but there was the concrete. And I hadn't saved up enough money for the concrete. And so I worked hard, I saved money, but there's always a little something extra. You need a little cushion, you need a little margin in your financial life, because everything's not always going to go exactly the way you want it to go. And he taught me that lesson about how to work hard, how to save, but he also taught me that there's always these little extras, right? All these little other things that kind of go with it. And you got to figure that out too. You can't ignore it. And I think that's an important story for our clients here, because the topic we're going to be talking today about taxes, and taxes sometimes are that little extra, that annoyance that you don't think of when you're putting together your plan. When you're making your money, we got to pay it. It's that little extra. But there's another key story that happened that same year. Is I told you I love playing basketball, and I was fortunate enough to make the middle school basketball team in Bloomington, Illinois. And we were in the playoffs, and something happened in the day of one of the playoff games. The other team's gym had like water damage or something weird happened, and we had to change where we were playing and when we were playing. And so all of a sudden we had this game, and we had this tiny little cracker box gym in our school, but we were the only place we could have the game. And so nobody knew that. And the game starts, it's quiet, there's nobody there. And I look up, and there's my dad in his suit, and he's the only person there. It's the only dad that found and made the game. Right. And so the thing that I think is important about today's topic is that what he taught me there is, for the people that we care about, we show up, right? We show up and we are there for each other. So a lot of what we have to do with our clients is help them understand the little extras, right? But then we just got to keep showing up and being there for them and so that we can help them through things. And so I got the person that kept showing up in my life and teaching me and helping me, and he still does to this day, is my father, Charles Ramsey. And so with that, I'd like to introduce him and let him tell you just a little bit about his background, because it's not just the fact that he's my dad that he should be here today talking to us about taxes. It's because of who he is, both in his background and his profession. So with that, Charles, why don't you introduce yourself to our listeners?
Yeah, I'm Charles Ramsey. So to tell you a little bit about myself, I, of course, grew up in a very small town in northern part of Arkansas, and pretty poor area. But I was lucky; I was able to be able to go to college and got a degree in accounting. And I started at a company in 1970 with as an hourly employee, actually. So I stayed with them for 33 years and retired. And when I retired, I was the president of the commercial tire division, which was a fairly good sized business. So my education was, I got a degree in accounting, I got a master's in management supervision, and I'm also a CPA. So that kind of gives you a thumbnail sketch of my background.
Yeah, and in those 30 some odd years of working, you did a lot of different jobs and you learned a lot of different things, but you started, Dad's got this, what I call this legal pad that he's had, and he keeps it in his desk drawer, and he can show you, he talked about working in 1970, but he can show you his financial investment portfolio all the way back to 1971. That happened to be, kept all these records and he kept all these things, and he would show them to me, and he'd start sharing these stories and telling me about it. And that's kind of what I want him to share with you a little bit today is he has a process that he goes through every year, where he thinks about his finances, especially about how he thinks about taxes. And I'm going to have him share with you a little bit about how he does that, because quite frankly, that's what we do, and how we show up for our clients is really, it's what I call, it's the Charles Ramsey method, right? It's this ability to plan and then look through it and look not only at the current year, but into the future years. So I'm going to call him Dad, because it's hard for me to call him Charles. But so Dad, why don't you, he get mad at me. I called him once in his office. That's another funny story, and said, "Hey, can I speak to Chuck Ramsey?" And he got on the phone and he's like, "Chuck Ramsey here." And I'm like, "Hey, Chuck, it's Brett Ramsey. How you doing?" He got so mad at me that day. He didn't like that. So I don't call him Charles or Chuck. I call him Dad. And so, Dad, why don't you tell everybody, like, what was kind of the first moment where you kind of, like, taxes made sense to you and you knew they were important?
Well, as I mentioned, of course, I had 43 hours of accounting when I got my undergraduate degree, and 6 hours of it was in taxes. And I soon realized that taxes is the number one killer of wealth growth. So if you want to accumulate wealth, you got to figure out how to manage around taxes. So that's how it started out. Like Brett said, I keep up with my net worth statement every year, and I have for, gosh, I don't even know how many years now. Probably about
It's
50.
52, since
Yeah.
1971 happened to be another very important year in our history, but
Right.
happened to be the year of my birth. But so I know he's been keeping track of it for every year that I've been alive.
So anyway, what I do on an annual basis, at the start of the year, I sit down and I project what my income will be for the year. And all of it's pretty much fixed now. The variable parts are dividend income and capital gains income. But I estimate my income, and then I go down and say, okay, what can I do to manage this as effectively as I can? And that's pretty much the process. So you go through each line item. Is there anything I can do on this line item to minimize the income I'm going to have to pay taxes on?
Right.
And that's what I do.
Right. And so now you guys can understand me just a little bit better, because here's a man of his own volition that sits down with a 1040 return every year, goes through it line by line, and looks at what can I do on this line to change the outcome and make it more favorable for me. And I'm here to tell you, like, that's exactly what we do. Now we have some fancy software to do it, where we can literally take your return from last year, upload it into our software system, but it does exactly what he just said. It goes through line by line and looks at, how do I make this line more favorable for me? What are the options and the choices and the things that I can do? So he said that he started with income. Now, for some of our listeners today, like he said, he's retired now. So on his income line, he has a pension. And so there's a pension income. He can't change that line. That line's going to come in. But then he talked to you about dividends and interest income and capital gains, right? And so some of our clients don't really think about those other lines, and one of our episodes, you can go back and listen to it, where I talked to you about this game I call tic-tac-toe. And in tic-tac-toe, you're going to learn that every dollar that you have is going to be in one of three accounts. That account is either taxable, that's what he's talking about now, where you get dividends, interest income. If I buy or sell something, there's a taxable consequence to that. That's a taxable account. Then there's tax deferred accounts. And we're going to talk a little bit about that later, where he talks a little bit about his IRA income and things like that, and when you have to take those. And then there are now accounts that really, when you first started investing, Dad, there were no tax-free accounts when you began this process, were there?
No.
And so now we have these tax-free accounts, whether we call them Roths or HSA accounts. And so I remember, once again, when I was pretty young, he was explaining to me the taxable and the tax deferred accounts, but we also have this tax-free category. So we got to go through there line by line and look at where these different income sources come from. And then once we understand where the income sources come from, we can start to talk about what we do with them next. And so once you kind of figure that out and you kind of look at your income, how do you manage that, Charles? Like, how do you think through the process of figuring out, is this the year I should take a capital gain? Should I buy or sell this thing? Or how do you even think about that?
Well, there are several things that affect your income and the amount of tax you have to pay that sometimes you don't think about. One of them is called the income-related monthly adjustment amount, which is really what it amounts to. Is if you have so much income, you not only pay the standard amount for Medicare, but you pay more. And it can be as much as $500 per month per person more. So I look at those cutoffs, and I obviously do not want to hit the next cutoff. So I manage my capital gains and my dividend income for that not to happen. So, but people just don't think about that. So, but that's one area. The other area is when you're taking distributions from your IRA, which you're required to this year, I think starting at 73. Of course, I've been having to do that for several years now. So as you might know, well, I know you know, but the last tax change materially changed the way people file their taxes. The majority of people nowadays cannot itemize their deduction because the standard deduction was doubled. And so therefore, my standard deduction last year was $30,700. So, and that also in that tax bill, they limited how much of local and federal or local and state taxes you could count. It's limited now to $10,000. So unless you have some other things, it is almost impossible to get up to the standard deduction amount unless you give a lot to charity. So, but there's a little deal in if you're taking your required minimum deduction from your IRA, there's a deal called the Qualified Charitable Distribution. And you can take your charitable contributions through that and have your record keeper to send the check directly to the charity, and you get to reduce your RMA by that exact amount. So now you not only can take your standard deduction, but you can, if you're given to charities, you can also take the QCD, which in my case, it's a significant tax savings of about probably $12,000 or so a year.
Wow. And now two things there that I want our listeners to hear. One is what I call did you guys know that off the top of your head? Because that's what I've been living with for 52 years. A man that knew exactly I didn't prompt him. He knew exactly what those cutoffs were. That's what we're talking about, where with the detail that you have to look at this at, right? So he knew what his standard deductions were. He knew where his income related Medicare adjustments could be, like where he would have to go. He thinks through those things on an annual basis at that level of detail. And then he knew the rule for qualified charitable distributions directly from his IRA accounts. Now, those three things, if I walked up to what I call a man on the street and I just put a microphone in their face and said, hey, do you know what QCD is? They're going to look at me and they're going to go, I have no idea what you're talking about. Even if I spelled it out, qualified charitable distribution, they're not going to know, right? So when we talk about the process of understanding your taxes and your tax return, understand the level of detail that's necessary and what do we say here at Artisan Wealth? Why is it artisan? Because it's handcrafted, right? That's where Charles's numbers are, Dad's numbers, right? I can tell you right now, your numbers are probably not going to be the same as his, right? So what we need to do is we need to be able to take your current circumstances and we need to look at every one of those three things that he just talked about and see, hey, do you qualify for that? Where do you fall on that chart? Right. So when we run this analysis for you and take your taxes and put it through this process, the Charles Ramsey process, right? And you look at it and you say, oh, well, here's where I fall on this. And so here's where I want to maybe manage my taxable income and how I want to maybe sell some stocks this year, or maybe take distribution from this account, or geez, maybe once again. And he also talked about charitable. Not all of our clients have a charitable purpose, but the reality is when you look at it, you may want one. So we talked about three different things here. One, we talked about income related to Medicare. Next, we talked about required minimum distributions from an IRA account, which most of our clients don't really understand that. It's just kind of forced on them. And then what are the ways that we can manage that, right? So there's a lot in there that he just unpacked for you, and he's doing this every year. And so, Charles, when do you start this process?
Actually, I started in January because I start determining if I want to sell any long-term, make any. By the way, I also never sell stocks that are short-term. My tax rate is above the capital gains rate, and maybe we should talk about the capital gains rate in just a minute. All your dividends and capital gains are taxed at 20%. So if your ordinary income tax rate is above that, obviously it's a good idea to try to get more income in that category. The other thing, though, you have to be aware of, there's a little thing called the net investment income tax, which is 3.8% that you will pay on all of your dividend and all your capital gains. So it's really, if you look at it in the aggregate, for at least for me, it's basically 23.8% rather than 20. But so what I do in January, I make out my estimated income that I expect that year. Start looking at things that I need to do to manage that to achieve the results that I want to target, and I calculate the actual tax liability that I expect to pay, and I try to manage to that. So let's say I wanted to sell $25,000 in capital gains, then I manage to that. I don't want to go over that, because if I do, my tax estimate is wrong. So
there's a powerful thing that he's talking about here, and I think we sometimes miss it in our conversations with our clients and in our industry. It's his portfolio, the things that he picks and the investments that he makes. He looks at those things, and then he compares and analyzes that also to his tax return. And so I happen to know not how he selects every single one of the investments that he makes, because what Charles didn't share with you, once again, Dad, was that in one of his roles, he was on the investment committee for the company, and they had a multi-billion-dollar pension fund. So on the next kind of conversation, when we're talking about portfolio management, you'll once again understand I learned from one of the best in the business, so to speak, happened to be my dad at this kind of stuff. But he looks at his portfolio and he looks at the things that he's going to be investing in, and he thinks very critically right at the beginning of the year. I know he sets what he calls price targets, right? Where he says, hey, if this investment performs this way, I've gotten kind of everything out of it that I want to get out of it, right? And now maybe it's time for me to sell it before it drops back in value. Or in his case, I also know he's not someone who's exceptionally greedy. When he hits a price target, he likes to take his gains and move on to his next idea, right? So there's a lot to learn from that, but it's also all in context of him throughout the entire course of the year, thinking about how is that going to impact my overall taxes? Because as you heard him say earlier on, what was the number one thing that could impede your ability to gain wealth, Dad?
it's taxes. There's no question about it.
It's taxes. And why is it taxes?
Because it's the number one item you'll spend money on. That's if you
It's
look
the
at
number one thing. Like when I talk to my clients where they spend money, what they don't say is taxes, right? So back to if I had $100,000 and I wanted to spend it, would I be planning to spend 30,000 of it on taxes?
no.
No. But we do, don't we?
We
Right?
do. If you
We
consider
do.
all the taxes, it can be up to as high as 50%.
Yes. And so if we don't think about tax planning as a strategic way that we look at our wealth, we're actually skipping the number one thing that we spend money on. All of us do, right? It's not a choice, so to speak, because we don't think about it that way, but that's what's happening, right? So we earned that dollar. We want to keep as much of that dollar as we can, because that dollar then invested for us and compounded over time is how we gain and add wealth. So if we don't spend time focusing on the impact that taxes have on that dollar, we're missing, in his estimate, the number one thing that prevents us from gaining wealth, right? So hopefully you understand why I'm passionate about this topic and this process, right? So now as we dive into this, so you're going throughout the course of the year, you start in January. Do you kind of have any checkpoints throughout the year where you kind of, kind of reassess what you're doing and kind of walk us through that part of it?
Well, of course, I monitor my investments pretty much daily. So when I sell something, I know how much gain I've got on it, and I just keep accumulating that. And I'm constantly monitoring the dividend income, and if I buy or sell something, how it will affect the dividends. I do think that dividend investing is a good way to grow wealth, but again, you have to keep in mind you're paying taxes on it every year. That's not one that you can get away from. So, but I monitor it pretty much. I mean, I hate to say this, but pretty much daily.
Yeah.
But
And so that's another little example where most of you aren't going to be like my dad. And to quote one of my favorite movie lines, that's why you need me. That's why you need me on that wall, right? Because we can do that for you automatically and pay attention to that as we're going. So that's kind of how you manage your taxable assets, Dad. There, you talked to us a lot about that, but I happen to know, because you worked for many years for one company, that you accumulated money in a retirement plan at work, and another chunk of your wealth is in the retirement plan. So tell me a little bit about how you think about the retirement plan. And now that you are a little older, I won't give away your age, but you have to take those required minimum distributions from your retirement accounts. Tell me how you try to plan and manage through that a little bit.
well, one of the things that I do in that portfolio is I do really focus on dividends, because if you're one of the problems you can run into when you're required to take a distribution is if you don't have the cash in the account to do it, you can be forced to sell something at a time when it's not a good time to sell. So what you want to do is plan throughout the year to have cash in that account to meet that required minimum distribution without being forced to sell something at a bad time. And one of the ways I do that is to try to accumulate dividend income. I have a target for that account on how much dividends I'd like to generate. So with that cash flow cost constantly coming in, it minimizes what I have to trade to buy or to sell or buy something during the year to meet those requirements. It's really just conceptually, it's the same thing as in a taxable account, except it's just non-taxable. Now, as Brett mentioned, they didn't have some of these, Roth and those types of accounts back when I started saving. So you definitely probably, if you're a young saver, I think that's definitely worth looking into, probably investing in those, because as I mentioned, and I'll say it again, taxes is a wealth killer. There's just no way around it. So.
Yeah. And so as you think about that, so once again, we've had conversations about that topic, and now you guys understand where I got that idea. Once again, I'm not the smartest guy. All I had to do was show up at dinner for the last few years into my life, and I got a lot of great ideas coming at you from a person who's lived it in his own life and demonstrated how to do it. But so what he talked about there was you're going to have to take so much out. And he used this phrase he didn't want to have to sell. Phrase that I use all the time is don't be a forced seller, right? Forced sellers lose, right? So how can we eliminate being a forced seller? Well, if we know at the beginning of the year, we're going to have to take a required minimum distribution from that account, we know how much money we're going to need in that account, and we can decide when we take it out, but we know throughout the course of the year, we're going to have to remove at least this much money from this IRA account. Okay. So when I have to remove that much money from the IRA account, I need it to be there in what he talked about I would use the word, it needs to be liquid. It needs to be in cash. It needs to be something I don't have to sell to get out. So he has dividend income coming in. We can manage that depending on your needs slightly differently, but we actually set up our portfolio to produce the amount of income that you need each month, each year to meet your required minimum distributions or whatever distributions you may need to live on. So it needs to be planned, right? So that when it comes out of the account, you're not a forced seller. Because I would say one of the other big ways to erode your wealth is selling things when it's not a favorable time to sell, right? Because markets are going to go up and down. This isn't a market discussion today, but the key is don't have to sell when it's down. And the way that we can eliminate being a forced seller is by planning it out, just the way Charles does each year, and to make sure that you have the income in there that you need. Now, one of the things you talked about earlier, and I know that you have some interest and you've served on some different boards and have things that you're passionate about and want to support on the charitable side. But when did you start giving directly from your IRA account to charities? What prompted that?
Well, really, it's when it became a requirement for me to take I started doing it really the first year. So that I was required to take it. So to me, it's just kind of a no-brainer. Like I say, basically, I'm doubling up my standard deductions, what it amounts to.
Yeah. And so he already was giving to charity. Now he was being forced to take money out of a tax-deferred account, a retirement account, and pay taxes on it. And so he just cut out the middleman by using a qualified charitable distribution technique, the QCD that he mentioned. He can give the money he was going to give anyway, right, directly to the charity. And now he doesn't have to pay taxes on that distribution. Now, once again, we don't like to do charts and graphs kind of stuff because this is a podcast, but if you're over 70 and a half, you can give up to $100,000 a year via QCD, right? It's capped at that. Those are the rules, right? But if you give anything, and he just said it enabled him to be able to give more or to have more in his own account because he didn't have to pay taxes on that money because he was able to bypass that tax piece. So that's a really big idea that if you are over 70 and a half and you have any charitable, it doesn't have to be a church. It could be anything that's a 501c3 that you're passionate about that you want to give or support money to, then you can do that directly through that process. Now, we've been here, and there's one other thing that I think that Charles does that's a little bit unique, and we've talked about it before, but when you get kind of towards the end of the year, what are you thinking about as you head kind of into that fourth quarter? What's your process that you think about there?
Well, let me go back to the required minimum distribution. The other thing that I think you can do is to hold your taxes. Even if you have other income, you can hold out your taxes out of the required minimum distribution and have your provider to pay directly to the IRS. Therefore, it eliminates the need for you to do quarterly filings. So I like that provision as well. I failed to mention that a while ago. But what you're doing at the end of the year is just kind of leveling up the ship, I guess. You're just trying to make sure that you haven't missed something, and you go back through your thought process, constantly analyzing what you've done and is it the right answer? And hopefully it is most of the time. There's always a few times it's not, but that's the way it goes. The only other thing I can think of on taxes, if you've got anything that qualifies cancellation and windows and stuff like that.
Oh, your energy credit. Yeah, you did some work on your house and got that.
Yeah, if you need anything like that, you can also plan that around taking advantage of those credits. And a credit, by the way, is $1 in tax savings. It's not a deduction. So anytime you can get a credit, you're a whole lot better off.
Right. And Charles doesn't live here in Indiana. Those of our clients that live in Indiana, that's one of the key reasons why we discuss the Indiana college accounts here, because they're not just a tax deduction, they're a tax credit. For every dollar that you contribute through the first $7,500 per year to a 529 account that's in the Indiana, you get a 20 cents credit. So 20-cent credit. So it's a pretty nice deal, getting $1,500 credit on your state income tax. So and these are lots of, like I said, I kind of stressed earlier is what I wanted you to hear today from my dad is it's not an accident. His taxes are on purpose. And what I mean by that is he has a plan. He goes into the year, he makes his plan, and he works his plan consistently over time. Now, when I was young and starting out in work, one of my coworkers once told me, he goes, plan your work, work your plan. That's exactly what Charles is doing. He's planning out what he wants for the year, and then he goes about working it, and he understands those different categories, and he understands those different credits and the deductions and the details of it. And so we don't want your taxes to be an accident. We want your taxes to be on purpose, which means what? We have to know your plan. We have to get your information. We have to look at what you've done in the past, and then we have to plan out your work, which is what we're going to do with your portfolio, your investments, the different categories. Where do we want to get our deductions and our credits? And then we go about living it out over the course of the year. Taxes isn't I show up at my accountant's office with a box full of junk and drop it on him and then say, geez, why do I owe money? And that's 90% of the people that we meet. That's their tax process. I got a stack full of return. I got all these things. Show up. He literally has a drawer. I can tell you where it is, and it's right to the right of where he's sitting right now. And he's got all this stuff in files. They're labeled, right? And so most people don't have that, right? You can see behind me. I don't have that. If you can see, it's a podcast. I'm a stack maker. This is like a filing cabinet guy. That's why we got other people on our team, not me, that are going to help you build good files. They're going to help you put things in the right spot. I'm just going to help you do the right process. So with that, Charles, is there anything else that you would like to share with our listeners today before we wrap up this episode?
No, not that I can think of. I think we've covered it pretty well.
Yeah. And like I said, this is 50 years in the making, the Charles Ramsey tax process, right? He had the educational background. He is a CPA. He had the tax classes, right? He then had jobs where he was helping a corporation figure this stuff out. And so he refined his process and how he did it over time. But now he works it every year, right? And so that's what we want for you. We want to be able to help you learn the same way that I did. I just got it at the dinner table. You can get it from coming to us, but this is the right way to think about your taxes. Well, there's this wonderful place. It's called the interweb. And if you go out there and you start typing in a very complex thing, it's called Artisan Wealth Strategies. You're going to find us because there's not another one of us out there. And when you get to our website, you're going to see ways to connect with us. You're going to be able to schedule meetings and appointments and phone calls, but get to know us, right? Because just like the story I was telling earlier, right? I remember that day still vividly when I was in 7th grade playing basketball, and my dad was the one that was the only one there, and he was still in his suit from work, and he found us. Why? Because you got to show up for the people you care about. And so we want to show up for you. And what that means is if we don't know you, we can't show up for you. So when you come and meet us on the web, let us get to know you. If we can't help you, we'll tell you that too. But I'm pretty sure that we can, because once again, this process works. It'll help you not just manage your taxes better, but it'll help you think through and create a plan, a strategy that's going to help you get to where you want financially. To be very clear here, it's why I'm here today, because it worked for him and he taught it to me, and I want to teach it to you. And that's how I think this thing will go. So come find us and we'll help you.
Thank you for listening to Handcrafting Your Retirement. Visit our website at www.artisanwealthstrategies.com or give us a call at 317-660-2855. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Artisan Wealth Strategies. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA, SIPC.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Dividend payments are not guaranteed and may be reduced or eliminated at any time by the company. Artisan Wealth Strategies and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor.